we're here today to talk about market updates, and Andrew is going to answer some questions. So can you please talk us through the recent movements within the market and the various investment sectors?
Yes, so the sectors that have performed particularly well over the last month or so continue to be the corporate bond market. So this is where companies are looking to either restructure debt. The debt was taken out a while ago and perhaps they were paying a higher rate for it, and now with the availability of cheap loans, they're replacing higher debt with lower rate debt. Or companies looking to raise funds for the first time to get them through the COVID situation. So we're seeing really good yields on corporate debt at the moment. The property account continues to be closed. Most of the property funds we deal with at the moment are closed for business. Doesn't mean to say that the investment is worth zero, thankfully, but it doesn't mean we can't actually trade these assets just at the moment. Hopefully that situation is going to improve over the next couple of months. We certainly hope it will. The UK equity funds that we use have been performing really well, and actually one of the highest performing sectors in the portfolio over the last 4 to 6 weeks. Especially the smaller UK companies. The smaller UK companies tend to go into recession, downturn, sort of with the highest level of downside, if you like, and then they're the first of the sectors to recover fairly quickly because of their size. So smaller UK companies have led the charge. In Europe, we've seen not actually much positive movement from the European funds we hold over the last month or so, although over the last 3 months they've performed really well. And the European finance ministers, heads of state, agreed a rescue or a bailout package for most of Europe a couple of weeks ago, and this should calm markets and allow money to be available, especially for the countries in the southern part of the EU. So Europe continues to be a market that we hold shares with. We then have, going over to international equities, Asia's performed particularly well over the last 3 months and indeed over the last 6 weeks, probably least affected by the COVID crisis, and there's good returns to be had there. The challenge we've got going forward is really the continual trade wars, tensions between, in particular, America and China, which have been going on now for a good number of years and really need to be resolved. Trade wars are good for nobody. And then we've got US equity, and US equity has performed really well, strongly. Some big American companies have announced some fantastic performance, especially the IT sectors. Growth we've never seen the likes of in the last few years. So really encouraging signs for US equity. And I think that's really most of the markets we're involved in at the moment.
Yeah, we have seen quite a bit of market volatility. Can you explain how the A.R.D investment portfolios have fared since the COVID-19 influenced the market crash back in February of this year?
Yes, the volatility was at the highest probably at the end of February, when the world suddenly woke up to the fact that this COVID crisis was going to have some major impact, and we saw the biggest falls within a week, 8 days really, that we'd actually witnessed since 1987. So some huge falls in markets that normally we would have expected some decent returns to be out of, but common sense seemed to go out of the window, and we saw some crazy moves in a lot of markets. Since then, the situation has normalised, if you like, and the last month I think has seen the lowest volatility we've seen over the last few months, with perhaps a new normal now taking hold. We're still waiting for the COVID cure, if there is a cure to be brought out, and that will certainly help things going forward. But volatility really is our big sort of positive for the investment funds that we use, because without volatility we don't see the dramatic gains that we've witnessed over recent years. So when prices significantly fall, we're then in the sort of realms of being able to buy assets at a cheaper valuation than we would have otherwise been able to afford. So volatility is actually a good thing. Obviously we perhaps don't want it quite as dramatic as we've witnessed over the last few months, but longer term it's good for the portfolios and therefore good for our clients.
And do you think that the market volatility will continue?
Well, for the UK, we've got a couple of situations because we have the world of COVID, as we know, but then the other thing we have for the UK is the Brexit negotiations, which continue to go along. So we will leave the EU at the end of the year, and whether we come away with a trade deal or not will sort of give us, until that point, some more volatility because of the fact that the markets don't like uncertainty. And again, the volatility, as far as we're concerned, then will drive future profits. Long term, we think actually Brexit, for what we do, for delivering profits, is actually very, very good for our sector. That there's some good money to be made there, especially when we look at the level of debt that's being built up in Europe at the moment. There is a huge amount of money floating around there that will eventually need to be repaid. And perhaps the UK, although we're borrowing significant sums of money, we're not borrowing quite as much as they are in the likes of Italy or Spain. So perhaps we're well out of actually lending money to these types of countries. So perhaps the UK will do really well out of Brexit, and probably better than we would if we hadn't had the COVID crisis.
So would you say that you're positive for the expectations going forward?
I think Rachel, you know, we're always positive. Because what we do fundamentally is make money for clients over a longer period. So over any time period that's worthwhile, which is really 3 years plus, we can deliver good returns. The short-term volatility, it causes issues for people looking to invest only for a short period of time, but we're not in that. If any client comes to us and says, well, I want to invest money for a year or two, then we'll say, well, actually, a lot of the investments that are out there are unsuitable because of the fact you could make a profit, but you could equally lose money. But once we look perhaps past the 2, 3, 4 year mark, we're making reasonably good returns. In fact, since the portfolio has been launched, we've made returns well above average. So we are positive in terms of the way the portfolios are positioned, and we're also positive for the money that is going to be made by our clients. So yes, we're always positive, probably even more so now. So it's certainly a good time to be investing.
Excellent, thank you very much.
You're very welcome.